The rebound continues after an astounding bounce back on Friday. We're seeing futures gain 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a serious talk after a clash at the White House with Volodymyr Zelensky and President Trump. They may talk again, but only if they take matters seriously now.
And countdown to Tariff Tuesday. Trump levies on Canada and Mexico may kick in tomorrow, potentially affecting $1.5 trillion in annual imports.
And this week also brings Trump's address to Congress, the U.S. jobs report. We have a speech by Fed Chair Jerome Powell, retail earnings to look forward to as well. All that and more coming up. But let's take a look at where these markets are trading with 30 minutes to go. Like Matt said, that bounce back continuing right now. We saw quite the bout of month-end window dressing to lift indexes higher on Friday, but we know that February in general was pretty ugly for equities. You take a look at the pre-market trade ahead of the first official trading day of March, a little bit higher on the S&P 500, a little bit more if you take a look at big tech in the NASDAQ 100, and then the bond market. This is actually the market to watch. I know that we're a stock show, but you take a look at the 10-year yield, higher by about 3 basis points right now, but the absolute level just astounding. We have some ISM data coming up at the top of 10, Matt Miller, and you think about all the growth fears percolating through this market, it'll be a big one.
Yeah, absolutely. Really paying attention to growth and inflation. I'm looking at European stocks for a change. That market still open, doesn't close until 11:30 New York time. These are defense stocks, and you can see the year-to-date surge. I mean, Hensoldt, for example, in purple, Rheinmetall there in blue have almost doubled as reports come out of Reuters that Germany is thinking about raising a 500 billion euro fund for infrastructure and defense, and Macron saying that the EU should chip in 200 billion for the defense of Ukraine. So the Europeans may be really getting things together in terms of funding, and they could be spending money here.
Devil in the details. Where does all the money come from? We'll talk a little about it, but good news for now. Looking at some stocks pre-market here. Coinbase Global up more than 9.6%. Of course, this is on the heels of the idea of a strategic Bitcoin reserve. You saw cryptos really surging over the course of the end of the weekend, and crypto-related stocks still up today, though some of the steam in the crypto markets overall less exuberant heading into Monday morning, up nonetheless. Capri up 8% pre-market on the heels of a deal. It says it's moving closer to selling its Versace brand to Prada. Also watching Intel up almost 6% pre-market. It is surging on a report that NVIDIA and Broadcom are testing chips on its manufacturing process.
All right, that is a fascinating piece of information there out of Reuters as well, certainly for Intel shareholders who've made that bet. I want to take a look at what's coming up this week because it is a big one. Katie mentioned that we will see ISM data at 10 o'clock this morning. But of course, there are a number of even bigger issues for this market. I think the tariffs is probably the biggest one. Mm-hmm. Will they or won't they? Tomorrow is the question. And then tomorrow night, we're going to see Trump give not a State of the Union speech, but a speech to the joint session of Congress nonetheless. And then we kick off, we wrap up, I should say, the week with a look at the labor market, so important to the Fed.
Absolutely. So we will see ISM data at 10 a.m. and we could see a big market reaction. You think about the 33 basis point decline in 10-year Treasury yields that we saw in February, really predicated on those growth concerns. We'll have a lot of temperature checks this week between, of course, ISM and also jobs on Friday. The address that we get from Donald Trump tomorrow, we know that he posted on Truth Social earlier this morning promising that tomorrow night will be big. I will tell it like it is, Sonali. That's a quote from the president.
Right. It's hard to know. You know, the last time we were going to see these Canada-Mexico tariffs, they, of course, were delayed. Let's see if we get the full tariff, lesser of the tariffs. This all comes against a really fragile backdrop for markets, guys. I also want to point against that fragile backdrop. We have the Bloomberg Invest Conference starting tomorrow. We have huge names. We have Carlyle CEO kicking it off. We have Bridgewater CEO to talk about what's happening with all the geopolitical uncertainty. We have the Blackstone COO, talking about the implications across public and private markets. And of course, we have us as we broadcast live from the set.
We'll be there both days, and we have a special extended show tomorrow. I think we'll be there 9 to 12, so looking forward to that.
Yeah, me too. Thank you so much. Anyways, after Friday's tense Oval Office meeting, we're talking about geopolitical tensions, so we have to talk about Ukraine's Volodymyr Zelensky saying that he's willing to meet Trump again, but only for a serious and constructive dialogue, as we've been talking about. Now, joining us now, Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Surveillance. Anne-Marie, given that you're just so close to the ground here, what was the fallout after that meeting on Friday that was so broadly publicized?
Well, I was at the White House on Friday. I wasn't in the Oval Office, but obviously I spoke to everyone that was in the Oval Office, following all the journalists and some officials as well. And I was there when they were preparing the lunch. I peeked into the room that they were supposed to dine in after they had that Oval Office meeting, and everyone was preparing for this to go through to sign that minerals pact. I will say I spoke to a senior official over the weekend who said, at the moment, there is no deal on the table right now. Obviously, potentially, maybe if the rhetoric and some of the tone from Washington, Kyiv start to settle down, we could see that coming to fruition. But what I'm hearing from the U.S. side is that there was a lot of back and forth and heated exchanges in Kyiv, in Munich at the security conference, and then once again in the Oval Office. I think if you look at what happened in the Oval Office, there's two things I would point to. One, it was 40 minutes in, and Zelensky said, after Vice President J.D. Vance was following up with a reporter, said, can I ask you something? And that was the moment that you started to see really the bickering start, and basically this blow up just spiral downward. Greg Vallier puts it this way: regular readers know we're huge fans of Volodymyr Zelensky, a hero in a world that has very few, but he's human and often rises to the bait, as he did last Friday. So you can see this having frank exchanges, and I hear about them between these two parties behind the scenes. What was so surreal about Friday was the fact that they were willing to do it in front of the press.
Yeah, absolutely. And also, I mean, it looked kind of like a setup. Obviously, a lot of us have seen the SNL cold open from Saturday night, in which they basically implied that it was Vance sort of leaning in and making that very butch statement in defense of President Trump, and asking Zelensky to thank the country once again. He often thanks the country and expresses gratitude to the U.S. You know, Alan Beatty in the FT writing that the U.S. has switched geopolitical sides and is now backing Russia against Western Europe on Ukraine. This is a sentiment that a lot of people out there, and I'm wondering how seriously it's being taken in Washington, Anne-Marie.
Well, the Trump administration will tell you that they're not backing Russia. They just want to be seen as more of an arbitrator of this so they can bring both sides to the table, which is why they don't want to go out talking disparagingly about Putin. Obviously, there's a ton of criticism and pushback for that, because President Trump just a few weeks ago said that Zelensky was a dictator because Ukraine is under martial law and they haven't had elections since the war began. This is a ton of criticism, especially from Democrats, even a few Republicans like Senator Lisa Murkowski, who we heard over the weekend. The one thing I heard, and Norman Rule, former U.S. intelligence official, joined us on Surveillance this morning, was the same people that are criticizing the Trump administration for running a rapprochement, a reset, maybe a little bit more of an open dialogue with Russia, are the same people that had no problems having an open dialogue and doing a deal with the Iranians, which are responsible and the U.S. would consider a massive sponsor of state terrorism.
All right, Anne-Marie, thanks very much. Anne-Marie Hordern there talking to us about the tense meeting on Friday and what the repercussions may be is something we can talk about right now with Dan Skelly, head of market research at Morgan Stanley Wealth Management. Dan, great to have you here on set with us. Thanks so much for joining us. We have seen a massive response in European markets. I was showing that chart at the top of Rheinmetall and BAE Systems, a bunch of European defense stocks that have, risen 50, 60, 70, 80% year to date. How much do you expect Europe to really get behind the defense of Ukraine and spend actual money at these businesses?
Sure, it's a good question. And look, they've been underspending, admittedly, for some time. So there's some catch up to come here. And I think it's going to continue. And just stepping back for a minute, Matt, when you think about the U.S. market the last year, the last 2 years, it has climbed a classic wall of worry. We disproved a consensus recession view. We got the 95 benign Fed scenario. We got past the election with no contested result. And we got the promise and the potential of a red sweep. Now I would argue in the U.S. we're hitting a wall in terms of fiscal policy uncertainty and high valuation. And simply put, you're seeing a ton of rotation out of the last 2 years winners into some new winners in the U.S. and, to your point, internationally.
Yeah, and I mean, you think about the Magnificent Seven, it feels like not only are we rotating, but we're selling the past winners. And you talk about this wall that we're hitting, that we're approaching in the U.S. on different fronts. Let's talk about on the earnings front, because we're just past really the heart of this earnings season. And it feels like, okay, maybe the look back numbers were pretty good. The guide's pretty impressive, just at a broad level here. And I just wonder how you think about that corporate America engine going forward.
Well, Katie, it's a great point. And frankly, we exited around 17-18% earnings growth in the fourth quarter, still expecting double-digit growth for the full year this year. But to your point, revisions have been lower. And the key point that we've been making for months now is the differential between Magnificent Seven year-over-year earnings and S&P 493 is compressing and is trading closer to parity after the Magnificent Seven was the only earnings game in town for 2+ years. And so what is that doing? It's quite efficiently leading to earnings stock leadership outside of tech, into financials, into other parts of the market.
So you talk about this compression that we're seeing, and maybe, you know, the 495, not 493, are finally stepping up here. But you think about just the math at the index level, the fact that these big tech stocks are just so big. Unless you have them stepping up to the plate and leading this market, it feels like even if you have this broadening out, it's not necessarily going to be enough to lift the index.
So that's an excellent point, and it's quite honestly in line with how we were thinking about this year all along. Interestingly, though, if you go back to January 27th, DeepSeek Monday, it was an 80% positive breadth day in the market, meaning NVIDIA was down 20%, powering AI, infrastructure utilities in that cohort were down 20%, but it was an 80% positive breadth day. What does that mean? That means that the rest of the market is looking towards positive fundamentals in the economy, albeit we had a pull forward with tariff buying. We can talk about that. We're naturally slowing, but you wouldn't see financials and the payment companies, Visa and MasterCard, at all-time highs if we were approaching recession. So simply put, you're right. The math of the earnings picture, the tech leadership fading, suggests something more akin to a normal year, a 5, 6, 7% S&P year, which we frankly haven't seen in 24 months.
No one wants that.
Yeah, I know. It sounds pretty brutal after 20% or more for the last 2 years. But speaking of the index level, you make this great point in your notes that the S&P 500 failed 3 times in 2 months to break 6,100. BTIG makes the point that for most of this year, the S&P 500 had less than 60% of its components above their 200-day moving average. The breadth sucks, to say the least. Wow. So how do you get past that? Are we looking at more of a drawdown before we see a tear higher?
So it's a phenomenal point. Great highlights. And all I would say is the following. Right now, you have a unique dynamic where it's not just economic and policy overhang, it's technicals. And I think you make the right point in terms of just how aggressively retail buyers were post-election in a lot of that momentum cohort. And so you've seen the technicals break down dramatically. Adding on to the retail momentum has been systematic institutional selling. And so you're in the perfect storm right now, to your point. What we would say is this is all par for the course for 2025. It's a very different year in terms of what we've seen the last couple of years. Lastly, on the 10% drawdown, we wish we knew exactly when it may happen, right? We'd be on our own little private island forecasting from Zoom. But having said that, it's likely to happen this year, but it's unlikely that the 10% becomes a 20% bear market because no economic recession, no earnings recession, no Fed hikes.
So that means if we do see a 10% sell-off, you're in there buying. And have you raised dry powder for that? I mean, everyone seems pretty fully invested. So have you sold off your Mag 7 stocks, a portion of them, in order to take advantage of a 10% drawdown when it happens?
We have. Within our equity strategies that I manage, my team manages, we have started rotating as of spring of last year into financials, into healthcare, into industrials. And we made the Magnificent Seven much less of an overweight, more of a market weight.
But you've got cash ready.
We have some cash ready, but at an asset allocation level, we've been practicing more rotation into value, into some mid-cap ideas, and to your point, again, out of some of the large-cap growth ideas, just trying to position for what's happening now versus jumping for a life preserver altogether and raising cash. We haven't done that just yet.
Dan, 15 seconds. I know you can't predict, when exactly it will occur. The S&P 500 down 1.4% in February. Is it possible that 10% correction has started?
It could absolutely be possible because, like we talked about, we are uncertain if the tariffs are going to be universal or selective in negotiating tools. We're unsure of that. We have tax day coming up in April, and we've seen pretty poor seasonality ahead of that as well. I think the negative earnings revisions, frankly, could continue. And then I think a lot of people, like we talked about earlier, are going to misread this pre-buy in tariffs for a more genuine consumption slowdown, which could all be part of the cocktail of a 10% drawdown.
That wasn't 15 seconds, but it was super interesting. Great to get some time with you. Hope to see you again soon.
Thanks, Kate.
That is Dan Skelly of Morgan Stanley. Now coming up, the tariff countdown. China, Canada, and Mexico bracing for bigger U.S. duties. The latest next. This is Bloomberg.
Let's get now to higher interest. Look at what's making headlines around the world. First off, a warning from Ray Dalio, the Bridgewater founder and former chief, says that the U.S. faces a major debt heart attack within 3 years if it doesn't commit to cutting the deficit to 3% of GDP, something he agrees with Treasury Secretary Scott Bessent on. Speaking on the Odd Lots podcast, Dalio warns the U.S. is facing the possibility of a lack of buyers for its debt, the servicing costs of which, by the way, are about 3% a year. Now, Ukraine President Zelensky said he's willing to meet with President Donald Trump again if he's invited. Zelensky said another White House encounter would have to be serious for him to make the trip. This follows Friday's explosive Oval Office meeting between the leaders of the U.S., Vice President J.D. Vance, and obviously President Trump, as well as Zelensky. Zelensky also said his country was ready to accept a natural resources deal with the U.S., something he's said before. And tariffs are set to begin tomorrow on China, Canada, and Mexico. Those North American levies risk driving up car prices for Americans by as much as $12,000. This according to a new study from Anderson Economic Group that sees the cost to building a crossover vehicle rising by $4,000, while the increase is triple that for electric vehicles. Tariffs are expected to affect some of the industry's most recognizable and best-selling models, including the Chevrolet Silverado pickup and Ford's Bronco Sport SUV. Katie?
All right, let's stay on that tariff story. One of the big stories of the morning. Joining us now is Brendan Murray. He heads up our global trade coverage over at Bloomberg News. And Brendan, we know that, of course, 10% tariffs were enacted on China. But you think back to the last episode with Canada and Mexico. We got that last-minute delay. As we count down to March 4th, is there any possibility that we'll see something similar this time around?
Yeah, I think there is, and it's it's being reflected in some of the things that we're hearing the administration say over the weekend. There was some talk of from Commerce Secretary Howard Lutnick that the president is seeing some flexibility in that 25% tariff that he's threatened on Canada and Mexico. So there seems to be, whether you're looking at financial markets or listening to the administration, it's fair to have some skepticism about whether we're going to be in an all-out trade war with across North America tomorrow morning. That said, there could be some sort of tariffs. Maybe they start off at a low level and say that's going to increase over time, or they target specific products to say that will just be the start of it if Canada and Mexico don't carry out the fentanyl crackdown and the border security issues that the U.S. wants them to do. So it feels like there's a deal to be had, but whether we can reach that by midnight tonight, we just don't know yet.
To that end, to Katie's point, when we saw the prior delay, there were a few things that you saw both Canada and Mexico put on the table. Are there specifics, Brendan, that we may know that the president in the U.S. would want to see? We know in broad strokes that he's looking at the fentanyl crisis, but what more does he want?
Yeah, well, I think he wants, and Scott Bessent said this in as much, he wants not just the border security issues to be addressed, but he's looking for more help in addressing the flood of Chinese imports that the U.S. is facing. Scott Bessent mentioned the phrase "Fortress North America," and he seemed to like that idea and said Canada is thinking about cracking down on Chinese imports. If Mexico and Canada could get together and do that along with us, then that sounds like a good approach. So it sounds like the makings of some sort of agreement or something that Trump could buy into. But we'll have to wait and see. There are only so many hours left in today, and from what we can tell, there isn't a whole lot of feverish talking going on yet. But there still could be this afternoon.
All right, Brendan, thanks very much. Brendan Murray is Bloomberg's trade czar, talking to us about these tariffs, which could come into effect tomorrow. Of course, we've seen tariff threats diminished previously already so far this year. Coming up, we're going to bring you fresh analysis on the rapidly developing geopolitical picture. Tina Fordham of Fordham Global joins us in the next hour to talk about Ukraine and tariffs with this White House. This is Bloomberg.
All right, welcome back to Open Interest. Minutes to go until the bells ring. You can see we're looking at a rally in the pre-market. The S&P 500 higher by about 0.4%. The Nasdaq 100 higher even still. And then the small caps also seeing a little bit of an outperformance here, at least relative to the S&P 500. We know we had a big day on Friday in terms of a rally, but a pretty bruising February overall. And we have some big question marks about growth, about the inflation outlook. We'll get maybe some startings of an answer when it comes to the data we have this week and also the tariff picture tomorrow. Now, coming up, we'll discuss the market moves with Maddi Dessner of Capital Group coming up next. This is Bloomberg.
Continues after a bout of buying on Friday afternoon. We are now seeing futures rise ahead of this Monday morning open. This is Bloomberg Open Interest. I'm Matt Miller. You can see green arrows here under S&P futures, even bigger under Nasdaq 100 futures. So those tech stocks could drive trade, at least at the beginning of the day. Russell 2000 futures are up just marginally. Here at the New York Stock Exchange, you can see Citi ringing the bell after last week transferring $81 trillion to one lucky customer, only for about 90 minutes, though. And then Euphoria ringing the bell at the NASDAQ marketplace. It's an awesome name, but the stock has lost 97% of its value in the past 4 years. In terms of the live trade, Katie Greifeld has a look at your averages. Katie, what do you see?
Well, welcome to your first trading day of March, and you can see we're starting on a positive note. The S&P 500 higher by about 0.3% if you round up. Big tech up about 0.5%. The small caps also seeing some love on this first trading day of March. Of course, we know we have a lot of risk events coming up just in the next hour even that could change this landscape. You think about ISM manufacturing coming up at 10, the jobs report on Friday, new tariffs coming tomorrow, and of course we'll hear from President Donald Trump and Jerome Powell somewhere in that mix. But at least for right now, there's green on the screen. Let's take a look under the hood as well. We're going to talk about crypto here. You have MicroStrategy, Coinbase, Robinhood, all surging after President Trump said that he's planning on including more cryptocurrencies than expected in a strategic reserve. There's some skepticism about that. Bitcoin itself is actually lower right now after a big rally yesterday. You can see that the actual U.S. listed equities, though, catching up to that weekend move now, led by the likes of MicroStrategy, up 14% right now, Sonali.
And Katie, I've got two words you might have forgotten. That is Merger Monday. I'm keeping an eye on Capri Holdings because Bloomberg learned that it's close to a $1.6 billion sale of its Italian luxury brand Versace to Prada. Capri up 8%. This is the stock, Matt, that was down almost 59% last year after its own deal with Tapestry fell through. Looks like it's doing deals on its own.
All right, finally, a report that NVIDIA and Broadcom are running manufacturing tests with Intel. Those reports are sending shares of Intel higher. This comes after Intel delayed plans for a semiconductor complex in Ohio until at least 2030. I know Central Ohio, the great state of Ohio, really was counting on that investment. So we hope it goes forward for the sake of those wonderful people.
Yeah, a lot of plans falling through in the world of AI. Isn't that the case?
Yeah, and Ohio definitely the story here. But I will note that this rise that we're seeing in Intel today, that builds on a pretty hefty year-to-date rally for the chip maker, up about 22.5% on a total return basis, a real reversal from what we saw in 2024. But let's broaden out this conversation at the market open and welcome in Maddi Dessner. She is Capital Group Head of Asset Class Services. Great to have you join us again, Maddi. And I look at your notes, and about midway through February, you downgraded your estimates for equity returns by about 50 to 100 basis points. At the time, you called out high valuations. You had moderated expectations for earnings growth as well. Here we are 2 weeks later, and it seems like the rest of the market has caught up to some of those issues.
Well, thanks for highlighting the work. You know, from our perspective, capital market assumptions. This is what we've put out there for our expectations for returns, correlations, volatilities of asset classes over the next 20 years. So this is not a tactical estimate. This is more of a long-term estimate as an input to our portfolio construction process. And when we think about equities, we have to think about a couple of things. Number one, as you mentioned, earnings growth, an important element of this, but also the valuation multiples that we expect investors to pay for that earnings growth. And valuations have come a little bit ahead of what we see in terms of earnings growth expectations for the future. So that's really driving the decrease in expected returns, particularly within equities. That doesn't mean we actually don't expect healthy returns out of equities. We absolutely do. So we've taken them down by 50 basis points, but that doesn't mean that we don't think people should stay invested. In fact, that is one of the key outcomes of this work, is the importance of staying invested. Cash yields have become incredibly enticing for investors, but if you compare that to what you can get from a fully diversified portfolio over 20 years, you're talking about a 200 to 300 basis points difference, which can make a real difference in terms of retirement outcomes.
Maddi, what do you think you do in a market like this, where you're seeing a lot of parts of the market having turned into a sour mood? To Katie's point, February was a tough month for investors. The broadening trade brought by and large this year, the S&P equal weight versus the S&P 500, the NASDAQ, had outperformed. Are you successfully able to turn out of big tech into other sectors?
Well, it's important to think about diversification over the long term, Sonali. So, you know, one of the things that came out of this work, the capital market assumptions work, and some of our product development activities is the focus on small cap. So this is a bit of a less loved asset class over the last most recent years. But if you look at the opportunity within small cap, it's actually quite interesting. First of all, to your point, you get diversified sector exposure, right? So less technology, a little bit more industrials, financials, consumer. So there's a differentiated exposure there. And we think there's lots of opportunity that will be unlocked within small cap over the next couple of years. There are about 29,000 portfolio companies held by private equity that we believe will be monetized over the next 2 to 3 years. That's going to be a tremendous influx of opportunity within the small cap space. So that's one area that if you think about more broadly diversifying your portfolio across large cap, international, small cap, you do get some mitigation of the risk of that concentrated exposure that we're seeing specifically in U.S. large cap.
Are you concerned at all, Maddi, about the risks of inflation? I just highlighted a story by Anderson that the average car cost could rise between $4,000 and $12,000. They're already priced pretty highly. If these tariffs go into effect, does that change your strategy? Do you think this is just bluster, or are they going to happen?
Well, certainly all of those elements get infused into how we think about the long-term exposure within asset classes, and specifically with the geopolitical risk, inflation risk. One of the ways that we have reflected that is by looking at where we believe interest rates will settle over the long term. So we think about short-term rates, we think about where rates will settle in the long term, and what the path will be in between. Our expectation is that given some of the geopolitical risks, some of the challenges that we have with debt to GDP ratios, frankly, all around the world, that interest rates will likely settle a little bit higher than they have in the past. One of the reasons for that is because central banks are walking away from quantitative easing. And what that means is that you've got more price-sensitive buyers in the market, not the central banks, people who actually are buying long bonds for a whole bunch of other reasons. And they are going to need a higher clearing price and a higher clearing yield to compensate them for some of these geopolitical inflation sensitivity risks. So that's some of the ways in which we infuse some of these challenges into our analysis.
All right, Maddi, got to leave it there. Great to get some time with you to start off this week. That is Maddi Dessner of the Capital Group. Some interesting commentary there to end on bonds. And I am so excited to hear from Jerome Powell himself on Friday. And you think about the information we'll have in our hands when we finally get there when it comes to tariffs, but also the economy. Specifically, he'll be speaking after we get that Friday's jobs report. And there's a lot of focus on the employment picture right now.
Jobs are tough, right? You're coming off a 4% unemployment rate and now looking at those DOGE cuts that are starting to hit the economy. Unclear. We were talking about it Friday as well, that you are starting to see more and more job cuts from big corporations. HP didn't really clarify to you where those job cuts would be.
No, we don't know if they're going to be in the U.S. or overseas, but I would say 4% is extremely low.
Historically low, but we all care about the rate of change, the level of change versus the absolute level. But there's plenty of different ways to skin a cat, if you will.
It's also a fragile market that we are sitting in right now, too. Let's put it against that backdrop, because 4%, if we were to slip lower or see any bad data in there, you're hurting the hurt.
A fragile market at its highs, though, right?
Not able
We're getting back to 6,000 today, and the high was 61.44
A lot
last.
can change between now and 4 p.m. We've learned that lesson over and over again. But it's a good point. We're at relatively low levels of unemployment, relatively lofty levels when it comes to the stock market. And up next, we're going to talk about crypto as well, because Trump's latest plans for the crypto strategic reserve are sending stocks in the sector higher, even as Bitcoin itself falls. We'll bring you the details next. This is Bloomberg. All right, welcome back to Open Interest. Let's take a look at stocks right now, because we're giving up some momentum when it comes to your major indexes right now. The S&P 500 still higher, but less so. The NASDAQ 100, similar story, still up about 0.2%, but we were looking at a gain of 0.5% just about 12 minutes ago. So really losing some steam here, as well as on the Russell 2000 with your small caps. Again, still higher, but less so. We'll continue to watch that one, but let's pivot now to our top calls. Some of the analyst action in focus this morning, and we start with Chipotle getting upgraded to a buy over at Morgan Stanley. The analyst says that the stock's weakness is an opportunity to buy into an excellent tech play. I'm not sure that I thought of Chipotle as a tech play, but Morgan Stanley does. Next up, we have Southwest getting cut to a sell over at JP Morgan on valuation concerns. The analyst says that the airline's best days are behind it. And finally, we have Deere, no longer a buy over at Baird. The firm cites weak commodity prices and trade uncertainty as reasons for the downgrade. You can see that Deere defiant right now, up about 0.2%, Matt Miller.
All right, we'll keep an eye on that. Could turn around, obviously, throughout the course of the day. Let's talk about crypto-related stocks surging after President Trump talked up, including lesser-known digital coins, as part of a strategic crypto reserve. Cryptocurrencies themselves are a little bit lower, but massive rally over the weekend. Bitcoin was up 10% in yesterday's trade alone. Joining us now for more is Bloomberg's Bailey Lipschultz. Bailey, You know, I don't know about those other smaller coins, right? I mean, who cares, honestly? Sorry.
Apparently the Trump administration.
Yeah, I mean, once you start ETFs being launched off of them, then people start to care.
But Bitcoin is what really matters, right? And it came back up over 90,000, and that's why I'm guessing we're seeing a rise in Coinbase at all this morning.
Well, the thing when you think about it, though, when you look at a Coinbase or other companies that kind of offer trading, Coinbase, Robinhood, even the semblance of kind of value in XRP, Solana, other tokens is actually bullish for those companies because they make money off of facilitating trades. So when you're looking at Strategy or MicroStrategy, Michael Saylor's Bitcoin engine up 10%, that's strictly driven by Bitcoin's rally in particular. But when you look at some of these other companies that benefit from other parts of the crypto or digital asset ecosystem, those stocks are rallying partly on risk appetite, but also just because if people are going to be pulled into these 8 tokens, then that actually just drives more trading, which by the definition benefits Coinbase.
Right, and those other tokens, I am going to go there because you are having ETF filings, particularly when it comes to the likes of Solana in the background. How likely is it that you see a reserve with assets that are not Bitcoin, frankly?
Well, the big question, Sonali, is what actually funds this? Is it buying? Is it strictly kind of tokens that are taken from bad actors that the government, instead of turning around and selling, just kind of puts on a hard drive? That's the uncertainty. That's the thing that analysts are discussing this morning, is what does this actually look like? Is the government going to go out and pump money into these tokens? Because by definition, that would drive some value inherently.
Is it bad to say that I'm a little less excited about whether we see a reserve or not, and more excited about the more near-term things like a potential for model portfolios at BlackRock having Bitcoin in it?
I don't think it's bad, Sonali.
I don't think it's bad either. I think it's exciting because I'm also excited about that. We got some news on Friday. I was off, but I still wrote this story, so I'm glad to talk about it.
Bitcoin ETFs, right?
Yeah, specifically their own. IBIT is the ticker, and it's at $48 billion already. And the asset manager announced that it's going to add a 1 to 2% allocation to IBIT in its suite of model portfolios that allow for alternatives. Model portfolios are basically funds that you package together and then sell to advisors. Advisors have been asking BlackRock for this, according to my reporting, and now they'll finally get it. And I think it's fun that it's just a 1 to 2% allocation, because volatility is the name of the game when it comes to crypto, when it comes to Bitcoin. Anything else than that, and your portfolio's overall volatility is going to go markedly higher.
Well, that's the big thing, though, that has been part of the pitch when you talk to crypto bulls, maybe the people who aren't all in and saying you should put your 401k in Bitcoin, but it's having kind of a flavor of that risk where if you do get that volatility, that impacts your underlying portfolio. But in a way, if you're looking out 20, 30, 40 years from now, maybe having 1 to 2% exposure to Bitcoin, even if it goes down to zero, isn't going to impact your ability to kind of live or continue to drive gains.
All right, we'll continue to talk about this on Sonali's Crypto Show.
Thursday this week.
Thursday this week. So if you had that on your schedule for tomorrow, move that up because we'll be at Invest.
Well, also the White House Crypto Summit is Thursday also.
Also that. So maybe we'll hear more noise, more pump from Trump. Thanks very much to Bailey Lipschultz. Coming up, Prada is moving closer to a deal to buy Versace from global fashion group Capri. Sonali was talking about it earlier. We'll continue that story in the Wall Street Beat next. This is Bloomberg.
Welcome back to Open Interest. We're looking at a stock market that has erased its gains on the headline S&P 500 level. We're now unchanged. The NASDAQ 100 not too far behind, and you can see the Russell 2000 leading the surge into the red right now. Little moves, but still the direction of travel is important here, and we are going lower ahead of course, an important ISM manufacturing report coming up at 10 a.m. Sonali.
Yeah, that's just what I was thinking. Volatile heading into that data. But it's time now for the Wall Street Beat. There are some stocks that are up, and they have to do with M&A. It is M&A Monday. Prada moving closer to a deal to buy Versace from Capri. Allegro is drawing takeover interest from larger competitor on semiconductor. And Philip Morris is exploring a potential sale of its cigar business in the United States. All that zen, I think, of those young ones are having. Let's get all the details with Bloomberg's Crystal Tse. I want to start with Capri, because we've been watching this stock, and it has really diverged meaningfully from Tapestry since the deal fell through and regulators clamped down on it. How badly do they need this current deal to go through properly?
So when the deal fell through, I think the world knows that Capri and everything that Capri is own is for sale. And so this shouldn't come as a surprise that there should be chunks of Capri coming out. Which the deal that fell apart tell us that it's probably not possible to buy Capri as a whole. So now we're seeing a tie-up between two Italian houses, big Italian fashion forces joining force. This Prada Versace tie-up would be meaningful, and we're not talking about an Italian version of LVMH, but we're looking at something similar on a smaller scale.
What's the story with? I'm more interested in the semiconductor stuff. Because Prada and Versace.
Luxury is so
Your priorities
fun
are
to
so
talk
wrong.
about.
I
Come
mean,
on.
He's
so
too
common.
upscale, you know.
I wonder about not just on semiconductor, but obviously because of I think it was a Reuters report. I wonder about people testing production with Intel at NVIDIA and Broadcom.
So this is a very particular deal. It's it's in chips for automotives. There are a lot of there's also a lot of political headwind, tailwind here. Like if you look at the Trump narrative is very much that they want to bring back oil and gas. So you could see like the chips that goes into these, self-driving or like electric vehicles could potentially take a hit. So there are some predictions that whatever it is, electric cars related, that could see a slowdown in demand. So this is to build scale, and any potential drop in sales would potentially be compensated by a tie-up of two automotive chip makers.
All right, so Sonali likes fashion, Matt likes chips. I like cigars, and this is another deal scoop that you helped break. This is that Philip Morris is said to weigh a sale of its cigar business, and for seeking over $1 billion. This is interesting on two fronts to me. First of all, the potential deal itself, but also it seems like this shift away from tobacco in general, and that's a shift that Philip Morris has made as well.
So they're shifting away from like anything that you light up.
Combustible tobacco.
Combustible tobacco is no longer in vogue, and even though you're just saying how it looks cool, the world doesn't like it anymore. The world doesn't like it.
You're saying that off camera.
Well, it's kind of cool, The thing about they own IQOS as well, so they're actually moving. They own
IQOS is heated.
It's heated. Apparently, the technology is different. That is
Right.
like healthier for you.
But it doesn't burn it.
You don't burn it,
Yeah.
so that is a big difference. And they're trying to move away from anything that you burn, and cigar is one of them. And this is actually also an asset that they inherited in a Swedish Match acquisition that closed a couple of years ago. So they're going through a portfolio review. So are a lot of big conglomerates, any sort of consumer company, any sort of industrials company that have multiple segments, do now have to look at them and say, which one do I not need, and which one will make more sense to help out valuation as without this asset.
Right.
Well, I too like cigars. Crystal.
Yeah.
The honey dip.
Every
that's
once in a while,
controversial.
not,
very
you know.
controversial.
You like to smoke a cigar?
every so
Like once a year.
Doesn't it
Yeah.
ruin you for the next
It's
day?
social. My hair smells like it.
on your birthday, why not?
I feel like I've eaten a bird cage when I wake up in the morning.
Anyways, Crystal, thank you so much for joining us here on set. One thing that's interesting about Crystal's commentary here is that you've actually seen M&A on the year down. It's down about 12-13%, and because of it, all the pure play investment banks have actually lost the Trump bump, all the gains they saw off the heels of the election. So if we look at a chart here of where they've come, you've seen Goldman, Morgan Stanley still maintain the gains because of their trading desks, but a lot of laggard trading here for what was a lot of exuberance coming out of the election.
I think this is, a symptom of the broader story that you think about the industries that had a lot of enthusiasm post-election. Obviously, banks were one of them, given we were expecting this friendlier regulatory environment, and maybe we'll still get it, but certainly it is not the topic of conversation. It seems like right now this market is pretty narrowly focused on tariffs.
Yeah, absolutely, and other geopolitical issues. But I wonder if you do see a pickup in M&A still throughout the rest of the year. Are we still betting on that?
Yeah, the Juniper deal was the one that a lot of people saw fall through and wonder, wait a minute, is the Trump administration going to be as easy as we thought?
And maybe we'll get tax cuts as well, which would certainly be market friendly. And you take a look at this market right now, we have erased our opening gains on the S&P 500, now down really across the board here, from big tech to small caps to the S&P 500. Now coming up, we're counting down to that ISM manufacturing data. We'll bring you the details next. This is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We take a look at markets right now with the S&P 500 firmly in the red as we count down to some important economic data, now down about 0.3% on the S&P 500, even more if you take a look at big tech with the NASDAQ 100 off about 0.5%. And here we have it, the ISM manufacturing figures for February coming in at 50.3. That is above the all-important 50 level, but below expectations of about 50.7 and below the prior reading of 50.9. And you take a look at ISM prices paid, a big surprise to the upside, coming in at 62.4. The prior reading was 54.9. You look at the reaction in markets right now, and bond yields, that sell-off has flipped into a rally. Let's get now to Mike McKee joining us from Washington. And Mike, for a market worried about growth, worried about inflation, I don't think that this report will do anything necessarily to soothe those worries.
I don't think so, Katie. The Fed is more interested in inflation than anything else at this point. So the fact that we saw a big increase in prices paid is something that's going to raise eyebrows over there. Does it mean that we're seeing companies already starting to react to the idea of tariffs? That's going to be a question out there. Now, we did see a big jump in imports of manufacturing supplies during the last month, during January, and we see that inventories in the ISM go up, but they're still below 50 at 49.9, and customers' inventories at 45.3. So it looks like at this point inventories aren't overwhelming, and that could mean another trade deficit surprise this coming month. The other thing I would point to is employment. After rising above 50% for the first time in some time, it's back to 47.6. So it does look like employment will be hit. Whether it's negative on Friday or not is hard to say. Don't look for improvement ahead in ISM. New orders are down to 48.6. They were 55.1 last month, and that may have had something to do with getting ahead of tariffs.
We've seen the whole market, Mike, turn lower on this. We just showed the equity indexes as we look at yields, really little changed here. But is it the prices paid number that you think is getting the market's attention? Is there concern that this shows inflation is a bigger problem than maybe the PCE number told us on Friday?
Well, I would think it's a combination of the prices and the new orders index. If you were looking for manufacturing and business spending to build up a little bit of GDP, if consumers are slowing down, you might not get that this time. And so that's obviously going to scare some people on Wall Street. And of course, any sign of inflation is a concern for the markets.
All right, Michael McKee, thanks very much, Mike, down in Washington, D.C. right now. Let's talk about this with Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist. Emily, we saw a massive rally into the close on Friday. Some have suggested maybe it was window dressing at the end of the month. Now to kick off March, we're looking at markets that are turning sharply lower. The NASDAQ selling off to the tune of 0.5% after opening in positive territory. What do you make of, first off, this equity market in the light of, I guess, volatile economic data that doesn't look as good as maybe we expected post-November?
Yeah, Matt, we're certainly hitting a bit of an economic soft patch here in the United States. Just last week, we saw a modest pickup in initial claims. We saw consumer confidence actually falling with expectations hitting a 3-year low. We saw weaker housing data coming in. So the Citigroup Economic Surprise Index is rolling over in the United States. The Atlanta Fed GDP Now forecast for Q1 is actually coming in at negative 1.5%. Mike McKee talked about that. One element of that is that we've seen an increase in imports and a decrease in exports. So really this all comes down to whether there has been a pull forward in demand and restocking prior to tariffs post-election. And now that's leading to this bit of an economic soft patch, this bit of a slowdown here. And I think certainly the data that we just got with new orders coming in much lower suggests that there may be a continued growth scare here playing out in the United States after that significant reacceleration that we saw to end 2024 and to start 2025.
I want to go back to that old saying about markets taking, and forgive me if I get this wrong, escalator up, elevator down. That's how it goes, right? And so we haven't seen the elevator. right? We've seen fits and starts. We saw an ugly February. We saw certain parts of the market hit correction territory. But if the data, as you suggest, is going to weaken so materially, then are parts of this market still way overpriced?
Yeah, potentially. You know, we came into the year at a really tough starting point at about 22 times forward earnings. We're down to 21 now. So we've seen a little bit of the froth left out of the market. But I would point to one positive thing, which has probably been overlooked, given the macro has really been dominating the headlines, which is that Q4 earnings season in the United States was pretty awesome. Earnings came in about 18% year over year. So the earnings engine in the United States is on. Yes, analysts are trimming their forecast for 2025. We've gone from about 15% earnings growth estimated down to about 12% now, but we're still looking at double-digit earnings growth. In addition, some of the more timely economic data that we watch, things like initial claims, which, yes, they picked up last week. There could be issues around weather and other distortions to the data. 1 week certainly doesn't make a trend, but they're still relatively low. We've been in the low 200,000, so not really a lot of cracks forming in the labor market, which is really critical. And then the other piece that we watch is high yield bond spreads. We're right around 280 basis points over treasuries. That's quite contained. If we started to see high yield bond spreads widen, Sonali, we'd probably be a little bit more concerned here. But overall, things are looking fine. Not great, but fine.
Yeah, I mean, if you're wanting to get nervous, you could point to what you're seeing in the high yield market, even in the blue chip market, and say, things look pretty stretched there, too, in terms of valuations. But I want to go back to what you were saying about earnings expectations. We're looking at still double-digit earnings growth. But as we were talking about with Dan Skelly just about an hour ago, normal feels pretty bad after the past couple of years we had. Even if we get high single digits in terms of price performance, total return performance when it comes to the S&P 500 this year, that might be normal on a historical perspective. But, Emily, we've been a bit spoiled.
We have. We just saw back-to-back 25+% returns for the S&P 500. That's only ever happened 4 times in history. Last time, of course, was in the late 1990s. There was one time where the third year also produced a 25+% return. And we can play a little trivia here. You'll probably guess that it was 1999. I'm not trying to compare this necessarily to the 90s. Tech companies make money now, which many of them didn't back then. But I think it's important to think about the starting point here. The nice thing, though, if you look towards 2025 earnings growth, is it's a lot broader. It's not just coming from Mag 7. It's not just coming from tech. We're seeing really healthy earnings estimates out of areas like healthcare stocks, utility names, industrials, which are benefiting from significant onshoring efforts that are taking place in the United States right now. So there's a lot of additional places to see those earnings drivers kick in 2025. It might be more muted, but we like the breadth that's available across earnings, across sectors.
Obviously we focus so much on these big tech stocks, and we could get into a huge discussion about whether the investment is going to yield return anytime soon. But I want to shift our view to the retail segment, because we do have earnings still coming out from Best Buy, from Target, from Ross Stores, from Kroger, from Costco. What do you think about the U.S. consumer right now? We have low unemployment, but rates are still relatively high.
Yeah, certainly the lower end consumers getting stretched here. But to your point, the labor market is still really healthy. We get another jobs report this Friday. It's not perfect. We're seeing things like the quit rate come down. So people don't feel as confident that they can leave their current job and go make more money elsewhere. Continuing claims are elevated. So once workers are filing for initial claims, it's taking them longer to find a job. But overall, the cracks are minimal. And as long as everybody still has a job, for the most part, consumers are going to continue to spend. All of those reports will be quite interesting. I can tell you, with preteen and teenage kids, all of those places see us frequently coming through their doors. So I think, by and large, the consumer still is in pretty decent shape here, although confidence is slowing.
All right, Emily, always great to get some time with you. That is Emily Roland of John Hancock Investment Management talking about maybe we'll start to see some cracks when it comes to the economic picture. We're certainly seeing some cracks when it comes to this market. You take a look at the S&P 500 at the NASDAQ 100 right now, both solidly lower as you see the bond market. That sell-off that we saw about an hour ago really has reversed. We're just about unchanged. But let's zero in on the S&P 500. You take a look at what's moving this market around. Your biggest contributor to the downside, you guessed it, it's NVIDIA, down about 5% right now. We think about earnings last week. It wasn't so bad. We had a wiggly sort of trade, but now it feels like any sort of optimism that was building has been completely extinguished. And NVIDIA for the year down over 12% at this point. That is taking a sizable chunk out of these broad indexes. And that broadening out, it's a nice to have, but you need to have tech participation.
Yeah, I believe Broadcom is reporting this week as well. It's a kind of a tough backdrop to put up a print.
Broadcom down 4%, the second biggest loser on the S&P in terms of points.
Yeah, absolutely. And, you know, let's look at the gainers, too, because I'm kind of interested to see why Tesla is moving in this market.
I mean, big questions there.
Well, I mean, Tesla's only moving 1%.
But it's
right?
your biggest points contributor to the upside, to Sonali's point.
And you do have it down still 27% on the year, 297. I have been watching where it has been going since that 479 handle that it held in December. It is still down almost 42%. So why buy now is my question.
And Palantir also right now a gainer up 3%, but I think it's more interesting to see these defensive stocks. Maybe Palantir is among them, right? You see Procter & Gamble rising right now. You see Costco rising right now. You see Visa rising right now. So things that you need. Philip Morris International. I'm not sure if it's because of the cigar business.
But here's my question on that too. Financials, that trade. If you're worried about a consumer, you're worried about inflation, and you have a yield curve that is not really materially steepening, what's the basis for the trade?
Yeah, a lot of big questions there. We'll unpack at least some of them coming up, but also coming up, we'll speak to the CEO of Just Salad because the chain, it's looking to make more green with its expansion plans, closing in on a big round of fundraising as well. Nick Kenner joins us next. This is Bloomberg.
Raisin lettuce. Let's get now to high interest, look at what's making headlines around the world. First off, European defense stocks are on a tear, fueled by optimism that the sector will see a boost from increased spending throughout Europe. Regional leaders in the bloc are reaffirming their support of Ukraine amid concerns over a U.S. policy shift in the region. And we've seen, this is just today, but some of these stocks double in terms of Rheinmetall up like more than 80% year to date. In the Middle East, Israel is blocking all humanitarian aid to Gaza after the first stage of the ceasefire expired on Sunday. Both Saudi Arabia and Egypt have criticized the move, saying aid should not be used as a weapon for collective punishment. Meanwhile, Hamas has rejected a U.S.-led proposal to extend the truce until mid-April. And grads from America's top business schools are struggling to find jobs on Wall Street and in corporate America. At every one of the nation's Magnificent Seven schools, including Harvard and Wharton, placement outcomes have declined since 2021. Given tuition payments now total over $150,000 if you are paying the full ride, which most aren't, students are starting to doubt their return on investment. Katie?
All right, let's switch gears here and talk about Just Salad, officially a unicorn. The fast casual chain securing $200 million in funding that values the company now at $1 billion. It opened 19 stores in 2024, aiming to open 30 stores this year. For more on the company's growth, we're joined now by Just Salad CEO Nick Kenner. Nick, great to have you with us. So this most recent round, it was led by investors including Wellington, D1 Capital Partners, Neuberger Berman, et cetera. Talk to us about what you're going to use this $200 million for.
Yeah, well, thanks for having me. And yeah, it's going to be a lot of new restaurants. So there's going to be a Just Salad coming to a town near you. We're really excited about the future and excited to keep growing the way we have. Not a lot is going to change. We're going to measurably scale, and keep the food fresh. And that's what Just Salad is about. Everything is about our product. The product is fresh. The chicken is fresh, marinated overnight, roasted fresh throughout the day. The produce comes in whole, washed on site in our kitchens. The dressings are house-made recipes that are made every day in our restaurants. So I think you can really taste the difference, and we're going to keep that.
So my understanding, too, is with a network of nearly 100 locations and a plan to open approximately 30 more, you mentioned meaningfully scale. What can you do in terms of expanding on that location base in particular?
Well, I mean, today we're really not that penetrated in the United States. We're in 7 states, so mostly the Northeast, New York, Jersey, Connecticut, Pennsylvania, Massachusetts. We're 25 restaurants in Florida, and we're opening in the Chicago area. But the whole rest of the country, there's massive white space. I think wherever there is fast food row, there's a seat at the table for just salad and this category. And I think we're going to scale in a way where quality isn't sacrificed. And we believe we have a best-in-class operations team, and we're going to grow at the level where they're comfortable. And right now, they want to grow faster, and so we're going to do that.
Nick, where do you see yourself fitting into the competitive, highly competitive landscape? Sweet Green, for example, is a place that a lot of people go to. And, I mean, how do you see yourself versus that business?
Yeah, I mean, consumers continue to choose just salad over others in our category and others in fast food in general because of our best-in-class product. And so I know it's old school, but you know, product and price point and operations still wins in the restaurant industry. And I think we do that better than anyone else in our category or fast casual in general. So our level of freshness, quality protein, small batch dressings, the overall flavor profile really shine through. That's a big reason we continue to grow faster than our competitors, both from total sales and same-store sales. We've had same-store sales of double digits the last 6 years, with the exception of 2020 COVID. And, you know, we have a best-in-class operations team. And I also think people really do appreciate the sustainability effort at Just Salad. So there's a bunch of differentiating factors, but product, price point, and operations still reign supreme in the restaurant industry.
Well, let's drill down on the price point, because there's sort of a meme out there about how expensive salads have gotten. The $20 salad, I don't typically think of Just Salad in that bucket, but how do you manage price pressures on your input costs? Because we talk about the price of eggs, for example, chickens with the avian flu that is sort of ravaging the nation's chicken stock right now. How do you think about passing on those costs to your end customers?
Yeah, I mean, we have a great supply chain team. So the last thing we want to do is just charge more and tax our customer due to our inefficiencies. So we're always going to look for alternatives. We're a scrappy culture, and we try and do what it takes to keep pricing. But inevitably, obviously, if there are inflationary pressures, some of that is going to be passed along to our customers. But our product typically is, depending on where in the country, $11.99 to $13.99 for a meal. And so we feel like we're still in that Chipotle, Panera price point. And those guys have, you know, over 10,000 restaurants between them. So we think there's a lot of white space for our price point.
Yeah, sky's the limit there. I do want to talk about the future a little bit more, because Matt mentioned Sweet Green. You take a look at Sweet Green's performance in the public equity market. It's come back to earth a little bit over the past couple months, but in 2024, this was a stock that was up about 184% last year alone. And I'm wondering, you know, as you continue to grow, you just closed out this fundraising round, but is an IPO something that you think about in the future?
Better be for these investors. It's definitely something we have an eye on and something we're working towards. You know, we'd like to be a little bit bigger in terms of sales, but, you know, we have a best-in-class restaurant margin. Our cash on cash is among the best in the industry. So we think there'd be a desire for us, but, you know, we think we have another year or two until that makes sense.
All right, Nick, great to talk to you about salad ahead of lunch, and also margins, obviously, are what investors care about. So if it's best in class, that's key. Nick Kenner there is the CEO, not only the CEO, but also the founder of Just Salad. I want to break some news here on TSMC. This, according to the Wall Street Journal. Donald Trump and the Taiwan Semiconductor Manufacturing Company are expected to announce a TSMC investment to the tune of $100 billion in the U.S. TSMC is looking to make some chip-making facilities, build some chip-making facilities here in the U.S. Of course, the lion's share of the Taiwan Semiconductor Manufacturing Company's manufacturing is in Taiwan. So this is an interesting story by Wall Street Journal. We'll continue to bring you any news on the chip sector ahead of the tariffs tomorrow. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, solar company SunNova is warning it may not be in business for much longer. High interest rates and lower state incentives have made it more expensive for consumers to buy its equipment. You can see shares down a whopping 56%. Next up, Canadians say that they're shunning Amazon thanks to President Trump's escalated threats against the country. According to a Canadian public opinion poll, 55% of the people surveyed said that they ordered less from the online retail giant. But as we know, opinion polls don't always accurately reflect consumer behavior. And finally, Walt Disney's Hulu streaming service crashed as the Oscars ceremony got underway yesterday. Tens of thousands of paying customers shut out during Hollywood's signature event. It was the first time that Hulu was broadcasting the show, and Bloomberg has learned the Academy is considering a move away from Disney when its contract expires in 2028. Now, coming up, the bird flu outbreak is spreading to cattle. We'll speak to Patrick Montgomery, the CEO of the meat retailer Valor Provisions, about his concerns next. This is Bloomberg.
All right, a new variant of bird flu has been discovered in U.S. dairy cows. The USDA found the new strain in the milk of 2 cows in Nevada. An older strain was linked to over 900 herds of cattle across 16 states. For more on the issues facing American farmers right now, we are joined by Patrick Montgomery, the CEO of a direct-to-consumer sales platform, Valor Provisions. Patrick is also a former U.S. Army Ranger, and Valor is operated by veterans. So thank you, first of all, for your service, Patrick. Let me ask about the bird flu issue. It's been a big one in terms of driving inflation. Obviously, the price of eggs is something that everyone has noted, but it's also been behind the death of 130 million chickens, apparently, over the last few years, and spreading to the cattle herd. How much of a problem is it?
It's a big problem, and it's not an easy one to solve. You're seeing the chicken houses when they are infected with bird flu or avian. You're seeing the entirety of that chicken house killed, right? But then you're still having interactions with wild birds that are coming into the chicken houses and then spreading the avian flu. So
yeah, it is. It's very troubling. I mean, you think about how it spreads through the air. So it seems like you say a hard problem to try to solve, but we've seen the impact on egg prices, on the price of chicken as well. How do you see it filtering through sort of cow prices and meat prices and beef prices?
Well, on the cattle side, the big issue there is we have record low inventory. I mean, we haven't seen the number of cows and beef in this country at this level since 1950s. And the reason is the economics for raising beef cattle in this country just aren't here anymore. So you're seeing generational ranches that are selling off their entirety of their herds, especially while live cattle and feeder cattle prices are at record highs.
Well, that's where I wanted to go. I mean, the farmers that you're in conversation with, that you work with, what do those conversations sound like? What measures can they take?
Yet there's not a lot. I mean, you're seeing input cost across the board, really since 22, rise drastically. And then in conjunction with that, you're seeing beef consumption in the United States rise 20% year over year. So those two things are kind of the perfect formula for drastic increases in beef prices.
I want to pull back here and look at the big picture as well, because you're looking at cattle owners really facing a stark reality when you talk about cattle prices, as you've been saying. But what about the import part of the story here? Is there anything that's happening with kind of the broader way that the tariff discussion is going on in Washington that would help in terms of beef supply in the U.S.?
Yeah, so it's going to be painful short term for the end consumer, right? And when I say short term, I'm talking 2 to 3 years, so not that short. But what has been happening for really since the 1980s and then exponentially over the last couple of years is like I said, is not the economics to raise beef cattle. And there's four companies that control 85% of the protein in the United States, and 2 of those are owned by foreign entities. And the economics are there in other countries because they aren't as regulated.
So the problem is twofold. As I understand, other countries have massive tariffs on our beef and dairy production, and we don't have tariffs on theirs. So we import a lot of beef and dairy products from other countries. And then in terms of the large factory farms in the U.S., there's foreign owners of them, which means fewer independent cattle farmers.
That's correct.
Do you think reciprocal tariffs then by the Trump administration would at least start to address that problem?
I think something needs to be tried and done. The big thing there too is that we don't have a free market, right, for cattle ranchers to sell their beef and make a profit. And so you're selling it. Your only option right now is you're taking it to one of those 4 options to sell your beef cattle, your pork, your chicken. It's all the same. So the incentive is not there to do the things that the consumer wants to see: organic, grass-fed, all the things that make for a healthy product. So you just have 4 buyers with Smithfield and that's not even including Smithfield. You have JBS, Tyson, National Beef, and Cargill.
So let's talk about how you fit in and how you're navigating all these different cross currents. What is your pitch to consumers, your direct to consumer? Why buy specifically from you?
Coming from being an Army Ranger before, I think the thing I missed the most was the purpose, right? I mean, there's no shortage of that. And so, the first few years at Casey Cattle Company, we had this awesome influx when we got named world's best hot dog, but, the purpose was still missing for me, right? Creating the world's best hot dog was awesome.
That wasn't enough for you.
It wasn't enough for me. But, we started to really take it on the chin in 22. Input costs after Russia invaded Ukraine went through the roof for fertilizer, for everything else. And what it led to was Valor Provisions, which is trying to solve these problems for the end consumer to make a healthy, affordable product and also taking care of the protein producer.
Now, that's on the consumer side. You laid out the problem pretty clearly for American farmers. What are some of the success stories that you have working with the farms themselves?
Yeah, so we launched with 3 vendors in November as really proof of concept. And I mean, we sold out of memberships in 5 days. And that was with 1 social media post and 1 email. And since then, we are paying drastic attention to the consumer on surveys and what do you guys want to see this become and how can we solve your problems? But then we're having direct communication with the actual producer of the protein to make sure we're keeping their doors open and cutting ourselves out as much as possible on the profit side. And we make our money on the lifetime membership. It's a one-time fee.
So what kind of future do you expect for Valor Provisions in terms of sales? What's the growth look like?
It's kind of like holding lightning in a bottle, right? So we've been really careful, and this is kind of the first light of day that we've given it because we want to make sure we get this right.
All right, great conversation. Really covered a lot of big questions here. Hope to speak again soon. Our thanks to Patrick Montgomery of Valor Provisions. Meanwhile, let's get back to these markets and the down day that we're seeing to kick off March. We're going to take a look under the hood right now with Bloomberg's Isabel Lee.
Hey, Katie, we're looking at Capri. It's up almost 8%. Shares are jumping as the company moves closer to a sale of Versace to Prada. That's as much as $1.6 billion, according to people familiar with the matter. Prada shares gained as much as 4.1% in Hong Kong, where the stock was listed, a nod to its big Chinese market. So a potential acquisition of Versace would allow Prada to create a larger Italian player, really to compete with the likes of LVMH and Kering. So that share That's really the big news for today, with shares up around 8%.
Isabel, let's take a look at Celsius, also on the rise. I can relate to this. I have a cherry cola flavored one on my desk right now. Why up? It looks like they're expanding their top ranks.
There is a people mover. Shares are edging higher by 1.2%. I myself haven't tried Celsius, but maybe later I will. But Celsius named former PepsiCo executive Eric Hansen as president and CEO. That's effective March 24. So Hansen has nearly 3 decades of experience in the industry. He most recently served as the senior vice president of PepsiCo, where he managed just a huge portfolio of brands amounting to around $3 billion. So recall that PepsiCo has around an 8.5% stake in Celsius Holdings. And Wall Street analysts recently reduced their estimates for Celsius after PepsiCo said that they reduced their inventories. But shares are seeing a little bit of a lift there, around 2% today.
So like 6 cups of coffee in 1 can of Celsius?
Or? I'm not sure. I never did the math.
We just spoke to the CEO,
milligrams of
you should have asked.
caffeine. Yeah, no, I know. In terms of Kroger, there's a couple of stories going on here, right? Number one is the company's performance, and number two is the CEO's, I guess, personal performance or his ethical performance didn't meet the standards of the board.
That is true. So shares are edging lower by 1.2%. It's another people mover. Kroger is the largest U.S. supermarket operator. They're replacing its CEO, Rodney McMullen, following an investigation into his personal conduct. But the company did stress it was unrelated to financial performance and didn't involve any of the Kroger employees. All they know is that it was, quote, inconsistent with Kroger's policy on business ethics. So McMullen has overseen Kroger for over a decade. He actually joined as early as 1978, where he started as a part-time store clerk in Kentucky, and he rose through the ranks. So replacing him is Ron Sargent, a lead director. He's now named chairman and interim CEO, effective immediately.
Isabel, thank you so much for keeping an eye on all that's moving under the surface. Now, coming up, we're going to switch gears. We're going to talk about the Oval Office showdown seen around the world. We're going to examine the fallout with Tina Fordham of Fordham Global Foresight. Next, this is Bloomberg. Now let's turn back to geopolitics, because after Friday's tense Oval Office meeting, Ukraine's Volodymyr Zelensky says he is willing to meet with President Trump again, but only for a serious and constructive conversation. Joining us now, Tina Fordham, Fordham Global Foresight founder and geopolitical strategist. Map out the path you see moving forward, particularly when you think about the way Europe is starting to position around the rift you saw form on Friday.
I love the idea of mapping out a path, but I think that crafting a decision tree is pretty fraught with peril at this point, because there are so many variables. I think the scene of the Oval Office meeting really took everyone by surprise. Zelensky was expecting to come and sign the minerals deal. I also want to highlight that it's fairly unusual what we've seen in the past week, with President Trump holding these long, 40-minute long press conferences. He had one with Keir Starmer. He had one with French President Macron, and then on Friday, the most unfortunate one with the Ukrainian president. For people in my world, foreign policy, it was described as an ambush, and that's certainly how it felt. But President Trump said he thought it made great television. So how does that translate into a map, a resolution? It's harder to plot than it's ever been. The term I use is non-linearities. We went from there, though, to what was regarded as a very successful summit over the weekend here in London, with heads of state from Europe, Canada, Turkey coming together in support of Zelensky, but more importantly, I think, talking about putting together a plan to bring back to the White House. And that's where all roads are still going to lead, back to the White House.
Tina, I wonder what you think about where Trump's allegiance lies here. Years ago, Madeleine Albright told Andrea Mitchell she thought he was a useful idiot for the Soviet Union. Today in the FT, Alan Beatty writes, it's another week in which we're on the brink of the biggest trade war since the 1930s, and it's not even in the top two issues facing the world. The U.S. has shifted geopolitical sides and is now backing Russia against Western Europe on Ukraine. Is that fair?
I'm not able to read the president's mind, but I will repeat back some comments made by Russian leaders. Dmitry Medvedev talked about how the change in U.S. foreign policy resembles our own. And so there are parallels between U.S. and Russia that simply haven't existed really in our lifetimes. And this is remarkable, it seems to me. I think we've really got to highlight that symmetry as being unusual. I also think that Donald Trump would like a peace deal. We know that he wants to win the Nobel Peace Prize. He talked a lot about being a unifier and bringing about peace in his inauguration remarks. And that may have something to do with his frustration with Zelensky. He said, not being willing to come and make peace and complaining about Putin. I think Zelensky felt he was under pressure to capitulate, and a bad peace, I really want to emphasize this, a poor peace deal with no deterrent is one that will be broken and might mean that there's conflict not just in Ukraine, but in the heart of Europe itself.
Trump often brings up a figure, $350 billion that he says the U.S. has given Ukraine. And I wonder where he gets that. He said it again on Friday. But the Kiel Institute and our own congressional oversight says that the U.S. has given about $120 billion to Ukraine. Europe has given about $140 billion to Ukraine. And, of course, Ukraine itself has spent well over $100 billion, bringing the total to that number that Trump brings up often. Do you know where he gets that number?
No, but others have written about his fondness of large, round numbers, and this appears to be one of them. It's also worth remembering that much of that money, if not most of it, went into U.S. companies for arms sales. So I've got to say, I am a geopolitical strategist. War interferes with growth and goods and services. And so despite these large numbers of aid for Ukraine, it is, of course, about preventing conflict from spilling over, but not just in Europe, because China is watching. Any country that it sees itself on the wrong end of somebody's interest, 85% of all wars have been fought over territory. And so the shape of a resolution in Ukraine really matters, because it's going to send a message around the world to other countries that would like, to take back, as they might see it, a bit of somewhere else that they would like to have under their national outlines.
Tina, one thing I'm curious about is the fallout across Europe, because very importantly, I think people look at Europe, they see headlines when they wake up in the morning about an increase in defense spending promised among regional leaders. But Europe is fragmented, deeply, deeply fragmented. So what types of disagreements do you see coming to the surface as the U.S. and Ukraine sort this out?
I think the scenes you're showing, the Lancaster House scenes, actually did not show fragmented Europe. They showed a remarkably cohesive Europe, including Keir Starmer, Brexit Britain and all of that coming together, and President Macron and Keir Starmer spearheading this plan. So there really isn't division in Europe about the importance of working together. There are some constraints when it comes to spending, particularly in Germany, because of its wartime history. There is a possibility, as we see it, that the so-called lame duck period, we don't really have that anywhere outside of the U.S., but there is a month before the new German government comes into power where they might be able to agree fiscal loosening, and markets would really welcome that. It would be net positive. We saw a strong open from defense companies here in Europe. So I think this is something that's positive that could come out of these tensions is for Europe to come together in pursuit of a common security and defense policy.
We have a viewer question coming in as well regarding tariffs, which is absolutely fair to think through. And Matt, maybe you actually want to weigh in here too.
Well,
it's a good point that you're making.
I'll just, the question, I guess, could be debated about who charges higher tariffs. But we have a viewer writing in saying, why did we allow the EU to charge us higher tariffs for 50 years and provide the continent with military support? Why was this never righted decades ago? Ari, spend on your own military and lower those tariffs. What do you think about that, I guess, assertion?
I'm not a tariffs expert, but let's remember that the United States and Europe are allies, and countries set their own tariffs. I mean, the U.S. military-industrial complex has benefited from countries around the world buying our weapons. So I'm not sure I understand the question.
I think Tina, he's saying, like, why are we giving them a good deal on tariffs, which is an assertion I'm not sure about, but paying for their military defense?
Well, on the military defense, this was by design. The United States did not want Europe to have an independent military. That's where NATO comes from. So I think some of your viewers need to go back a little bit to history, to understanding the post-war settlement that got us to this place. I think we should also be prepared for the fact that not just Europe, but Canada, Japan, Australia, South Korea, traditional U.S. allies are very unhappy about being singled out for tariff treatment, and they will retaliate. So this could potentially unleash a pretty unpleasant chain of events. These moves directed at allies, and whether they're for revenue generation or something else, it really still isn't quite clear.
All right, Tina, we got to leave it there. Really appreciate your time and your insight today. That is Tina Fordham of Fordham Global Foresight. And tomorrow, tune into a Balance of Power special ahead of President Donald Trump's address to Congress. Coverage begins at 8 p.m., I think, New York time. Actually,
definitely an evening event.
It says 9 p.m., actually. We'll address what's going on in prompter. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. Let's get a check on these markets with the S&P 500 lower on the day. Not quite at session lows here, but down about 0.1%. About the same story if you take a look at big tech, down about 0.1% as well. A lot of action in the bond market. When you take a look at the 10-year Treasury yield, we are below 420 on your benchmark yield. A little bit of a rally that materialized after this morning's sell-off, after we got those weak numbers on ISM manufacturing at the top of the 10 a.m. hour. We're still above 50, but just so.
Yeah, it's both growth scare as well as do I worry about inflation when you look at what's going on with that ISM number. The sectors that are benefiting from this are interesting. To your point on the 4.2% on the 10-year breaking below that level, you have real estate and financials leading the market right now in addition to those consumer staples.
Yeah, I thought ISM was fascinating because new orders are looking at a contraction, a reading of 48.6, whereas prices paid was far higher than the survey had estimated at 62.4. We should clarify that our coverage of the not State of the Nation Joint Congress address tomorrow starts at 8 p.m. And we are going to be live from the Invest Conference tomorrow and Wednesday. This is Bloomberg.